Good afternoon, everyone. I hope you're all doing well and staying safe. I'm Stu Reynolds, your host for today's webinar, and I'm thrilled to welcome you all to this insightful session on building and funding startups in 2024. So before we dive in, I'd like to introduce our distinguished guest, someone I've had the privilege of knowing for some time now through our mutual engagements in the tech ecosystem. And our speaker today is a luminary in the world of VC, known for his keen insights, strategic acumen, and unwavering support for founders. It's none other than Matt Browne from Black Nova Venture Capital. He brings a wealth of experience and expertise to the table. He's been a driving force behind the Aussie tech ecosystem for some years now. He's achieved many, including an 8-figure exit at Donesafe for B2B SaaS, by Combinator alumni, venture capital at Antler, of course, managing partner at Black Nova VC. So Matt has been at the forefront for innovation for over 20 years, mentoring and investing in hundreds of startups along the way. And his first-hand experiences of what makes a successful company tick will be invaluable as we start 2024. I'm sure that today's webinar will be enlightening and inspiring for all of us here. Without further ado, I'd love to welcome Matt.
Thank you, Stuart, for the kind introduction and great to be here with you all today. I'm going to talk a little bit about building and funding in 2024, and I like to say it's partying like it's 2015 to 2019. So, 20 to 22, there are a couple of blips there on the way the market saw startups. I think funding volumes were the highest they'd ever been. Money was cheap. More companies were starting and being funded than ever before. However, if you've read the recent startup report that was released today, you will have seen that obviously contracted through sort of the second half of 22 and then into 23. And I think 24 is going to feel a lot like 25 to 2019 in many ways. And we'll cover some of that as we go. I do have to just show this 10 or so seconds. You can read it very quickly. As I run a venture capital fund, we do have to put a quick disclaimer up there as we do trade under Boutique Capital's financial services license. And Stuart gave me a kind introduction. Just to give you a little bit more background, I started my digital career all the way back at the age of 18, or technically I started it when I was 13 with my first computer stand at the North Rocks computer market, but got heavily into tech in my very early years and had a career at PBL Media in the early days of digital. I was involved across a nearly decade-long career in corporate, so in tech and operations in businesses across media, mining, manufacturing, construction, and banking. It was through that experience that I launched my first software business back in 2013, which was called Donesafe. And over just under 7 years, we scaled that to 1.5 million monthly active users, so quite a decent user base. We had about 35% of the ASX 200 as customers and 11 of the top 50 global companies using our product. During my time building Donesafe, a friend of mine from my corporate career tapped me on the shoulder and said, "I love what you're doing at Donesafe. Can you help me do the same with Whisply?" And so I launched my second software business, Whisply, which was a whistleblowing software business that came out of finding the third largest fraud in Australian corporate history. So my business partner in that business was in the procurement function of a construction business. During his time there, they identified that one of the CFOs of one of the regional businesses had been pilfering for 12 years and had been spending all of that money on motorbikes and other things, which I won't name on a video recorded conference. That then led him to want to build Whisply, which was able to get into YC. I think we were the 7th Aussie company to get into YC at that stage. And that was an incredible experience moving over to hang out in Mountain View and live out in Palo Alto whilst we built the Whisply business. And we now have a little over 300 enterprise companies globally using Whisply, businesses like LVMH over in France, and locally businesses like Qantas. I then got the bug of investing after launching my own software businesses and made a little over 100 investments across funds and direct angel investments, which then led me to start my own venture capital fund, Black Nova Venture Capital, predominantly after spending a bit of time helping Antler as a founding venture partner there and working across now, I think, 11 cohorts with Antler. And so what I really wanted to bring to Australia was what I saw when I went through the YC program, which was more operator-focused funds. So in YC, the best performing funds that sit in that pre-seed stage that pick the best companies out of YC are typically exited entrepreneurs who band together and then back those businesses and provide a ton of operational support and guidance. And that was really the reason we wanted to start Black Nova VC. We wanted to have a pre-seed thematic fund built by founders for founders. I'm a father of 6, which also keeps me busy. I treat them like 6 individual startups, and also like to collect cigars. So just a little bit on Black Nova before I dive more into 2024. So we are building the leading early stage thematic B2B software fund here in Australia. Our first fund is only a little over 2 years old, has been performing incredibly well. And we believe in what we call 99-1, which is 90% of our investment decision is related directly to the humans that are solving the problem. 9% is related to timing, is what you're building at the right time to go and win a category, and 1% everything else. And I think that lens has helped us to pick some incredible founders to work with who have also picked us, which we're incredibly grateful for, and which has delivered us a pretty impressive early IRR as a fund and a really high performing first portfolio. And off the back of that, we've recently launched our second fund. So outside of Black Nova VC, why Australian startups? Why build a company here in Australia? Why invest in a company here in Australia? Well, if you haven't read the report this morning, I urge you to absolutely read the report from Cut Through Ventures. I think it's gone really deep on our ecosystem. And while I mentioned already, the last couple of years were probably tougher than the 2 prior, but probably looking more like what the last decade has looked, excluding. The Australian ecosystem has really hit a level of maturity. This is really a flywheel, and this flywheel has been operating for as long as I've been building software and continues to spin at a faster pace. The availability of capital, obviously, as a market matures, more capital comes into that market. And if you exclude those 2 frothy years, the momentum of capital is still increasing into this asset class. What typically happens, though, as businesses start to do well, is the employees of those high growth startup businesses start to get the bug themselves and think that it might be the right time to build their own software business. That also creates a bunch of talent with experience that can come and join new software companies as well. So we're seeing a real growth in talent across that sector. You'd be living under a rock if you haven't seen the accelerating pace of change in technology. I like to think about waves of technological change. So if you go back to mainframe to personal computer to cloud, and little blips like crypto, which is still very much there. And I think there's some really interesting technologies happening on the blockchain. However, it obviously had a big rise and then a big fall and then a small rise again, if you look at the currency side. But then other big waves like cloud computing, the rise of AI as a commodity. So commoditized AI infrastructure, I think, is probably one of the biggest shifts or waves of technology that we'll see in our lifetimes. I like to compare it to the cloud computing, where you had the big infrastructure cloud players, your Amazons, your Googles, your Alibabas, your Microsofts, who were able to launch large cloud infrastructure businesses and become the lifeblood of many waves of technology change and some incredible companies building on their infrastructure. I think the same thing is going to happen with this AI wave. There'll be infrastructure winners, but there'll be a ton of businesses that are launched on top of that infrastructure that will change the way that business is conducted, will change the way that businesses operate, and will create immense value and wealth for their founders and their investors. So I think the shift is one of the most exciting shifts that we've seen, or definitely that I've seen as somebody who's been building and investing in technology for over 20 years. The ecosystem itself has greatly matured. When I launched my first software business back in 2013, there were no more than 4 or 5 groups that were calling themselves VCs in the Australian market. And even a couple of the ones that were calling themselves VCs in the Australian market either didn't have any capital because they'd already deployed it, or were in the process of raising their first fund. So it was a fairly early place to be raising capital when I started. If you look today, there's over 100 registered venture capital funds in Australia now. The vast majority of those were thanks to changes in legislation allowing for some really great tax incentives with the SVCLP, Early Stage Venture Capital Limited Partnership. And so there's been a boom of smaller funds, including my own, which have popped up over the last half a decade. And of course, if you can't see it, you can't be it. And Australia's generated some fantastic unicorns over the last decade. And that definitely then creates second order companies that are chasing to become the next big thing. And so I think all of these things really lead to Australia being a fantastic place to build. I'm always buoyed when I head over to Silicon Valley and I attend things like SaaStr to see the number of Aussies on stage per capita and the number of Aussies in attendance. It's really impressive to see. And so I think 2024 is going to be no different. So why is now a great time to be thinking about building or investing in a software business here in Australia? Well, if I look at the investment side, depressed valuations, and potentially this year we may finally start to see some interest rate relief. Or the announcement must be any time now. But that hopefully we'll see a pause or a reduction. But depending on who you talk to, there could be one rise or two reductions this year. We'll wait and see. Definitely create a significant opportunity for investment. And so I think one of the challenges of investing in 2020 and 2021, valuations inflated to such a point that investing, and while there was a lot of cheap capital available, there's been a hell of a lot of sideways and down rounds since. And so getting the balance right between founders raising enough money at a fair valuation where everyone wins, I think they were hard years, whereas I think we're now back to a more of a normal. I think also when you look at the US, they went through a pause period of later stage rounds. You were definitely seeing less later stage rounds being done over the last couple of years. But in the last quarter of last year, that started to unfreeze. And again, when I was over in Silicon Valley in September, there was definitely a opening up to doing later stage rounds. However, the valuations are still remaining suppressed on what they were. So this means that I think the value exchange is probably at a fairer position, which means that I think this year you'll start to see a bunch of investing start to happen again. Not that it didn't happen, but it just happened less. I think you'll see a bunch starting to happen again. But I think also for founders who are building in Australia, finding international investors is becoming easier and easier than it used to be. And one of the reasons for that, especially in their later rounds, is that there's a really great exchange in value between Aussie dollar and US dollar at the moment. And so you'll find a lot of US funds are starting to look to Australia and send their scouts here because they believe they can get better value. But in return, Aussie founders are getting exposure to much bigger markets and support in much bigger markets earlier and easier than they used to. And so I think that's, again, a really good win-win value exchange. I think also investors, because of their large raises through 21 and 22, up to mid 22, are sitting on pretty big war chests and have been trigger shy over the last 12 to 18 months of investing. And so are sitting on some pretty big war chests. So they have to invest that money or they have to return it to investors. And so VCs don't like returning their money to investors until they've made some money on it. So they'll typically deploy it. And I think that will start to see, again, a bit of an unfreezing and more investments happening, especially where a business can show that they're building something incredibly valuable with good unit economics and exporting. So I think timing really favors the brave. This new wave of technology disruption is going to create the companies that will own the share of wallet over the decade and beyond. And this downturn will inevitably create opportunities for a number of startups and enterprises and for founders who have the mettle to get through and actually build a profitable business or a business that can at least be default alive and keep itself alive. These businesses will find funding when they're able to demonstrate that. Typically, periods where funding markets have been more constrained have actually generated the best companies, and those companies have gone on to return incredible results for their investors. I think that Australian founders on a global scale are some of the most resilient founders in the world, and that comes from a tyranny of distance, but also Australia is a harder market than it has been historically, a harder market to raise in than the US or parts of Europe or Canada or elsewhere, which means that founders need to do more with less. And so I think we build some incredibly resilient founders here who build great companies. And I think the macro environment will continue to provide new and exciting opportunities to chase down. And I'm going to dive into a number of those themes in the coming slides. So the big one, and I'm going to cover a number of macro trends, but I grew up watching, I remember, not that I should have watched it at 7, but my cousin got in trouble when I was 7 for making me watch the Terminator 1 and Terminator 2 movies. Skynet was the threat that I grew up with. When I first thought about AI, I was thinking very much about the robots taking over. And there are still a number of people in AI considering this may be an existential threat for civilization. If we look at AGI, the AI obtaining and surpassing human intelligence, there are talks about that maybe is already here and is just being kept under wraps for the moment. The famously Sam Altman leaving and coming back in a short period of time, from the whispers that we hear, was very much related to AGI. There are a number of workforce changes that will come because of AI. There will be jobs that will cease to exist. There will be jobs that will become augmented by AI. And I look at organizations that do transactional work. I look at anything to do with documentation that doesn't require a level of human understanding or creativity will be very quick to be replaced by AI over the coming decade. But I think I like to be on the optimist side of where things will go with AI. And when we look at the last order of disruption and tech changes that have happened, whilst there have been many jobs that have changed or ceased to exist, there have been a ton of new jobs that have been created. And so I think people will start, human creativity is one of the strongest things that humans have and one of the differentiators from the rest of the animals that we share our planet with. And so I like to live in hope that creativity will continue to generate new jobs alongside AI, making some of the things that we don't necessarily want to do easier. This will create, I think, a two-speed investment economy. So you'll have the businesses that will be retrofitting decade-old technology with AI. So they have one advantage in that they will often have large amounts of data. A disadvantage, that data is not structured nor ready to work with AI. And so there'll be a lot of work for those companies to build novel solutions that continue to maintain their dominance as market leaders. And then there'll be a generation of brand new companies that are AI native from day one, that are starting to win categories that were dominated by the players that won the cloud revolution. And so I think that's probably, as a VC fund, that's the sort of stuff that we're looking to back and that we're really interested in. Who's going to go and win verticals? Who's going to replace what were once considered sort of blue chip cloud players or infrastructure players prior? And if you just have to look at Product Hunt, nine out of every 10 launches is AI related. I think if I look at what we're looking at as a fund, it's very rare that we're seeing a pitch that isn't AI related. And I like to say there's three kind of tiers of AI that we see. There's the infrastructure, there's the co-pilot or AI enabled commoditized, and there's the I don't know what AI is, but I need to put AI on my deck to get funding. And so I think very much we'll continue to see hopefully more of the first two and less of the last. But there are also a ton of other macro factors to consider if you're looking at building a business today, or if you're looking at what direction you may take your business over the next decade. So obviously the energy transition, corporate net zero targets, the rise to dominance of electric vehicles, big infrastructure investment, hydrogen economy, ongoing R&D and fusion, and the very first fusion reactor, small fusion experiments showing that they can have positive energy. There is a huge amount of activity in that space, and I think investors will be actively monitoring that category to look for who are going to be the new energy winners. Supply chains got massively smashed through the COVID period and have taken a long time to recover, which opened up and put people's eyes on supply chain transparency and supply chain effectiveness. So, and also a bunch of legislation, both globalized legislation and regional domestic legislation, changing the way supply chains will work forever. This also creates a ton of opportunities for building. Rapidly reducing fertility rates. You can watch some great podcast, video cast episodes with Elon Musk recently talking about rapidly reducing fertility rates, and the fact that the US has been below replacement for 50 years, and Japan and China and others are struggling to replace their populations. And so you're going to see an aging population that's going to need care, and that care is most likely going to come from a blend of human and technology. So a number of new opportunities that are popping up there. An ongoing cybersecurity arms race. Cybersecurity is becoming the hardest thing for directors and business owners to consider when thinking about risk management and defending their business. And that's not going anywhere soon. AI is making cybersecurity both easier and harder at the same time. You just have to go onto the dark web and you've got a fraud GPT, which enables you to basically go out and start building your own threats and attacking with them. And on the other side, you've got companies that are thinking about how they use AI to automate the security engineering roles and various other things. So I think cybersecurity arms race is not slowing down. The intersection of health and data. For a very long time, health data is always one of the most sensitive areas of data. It's also one of the areas that needs the most trust and the most time before you start to adopt and trust solutions. But with the ability now to utilize AI and utilize large language models and utilize predictive analysis and other forms of technology to look at potential interactions between drugs, potential new solutions for health problems, I think that space is going to be a really hot space over the coming decade. I think we've doubled up a little bit on my supply chain messaging, so I'll skip supply chain again. I think workforce transition. So as people start to go through reskilling and org change, there'll be a number of opportunities on marketplace, on education to help a workforce transition to the next waves of technology adoption. Again, the Apple product is whether you're a believer or whether you're a naysayer to Apple's latest technology. I think there are some that believe it could be the future of work and that we're all going to be walking around with headsets on. I maybe slightly more in the detractor camp. I think the hardware is still pretty uncomfortable to wear. So I think until they get that right, it's probably not going to be changing too much the landscape for how we do business. But again, I think that is a space that when the hardware is right, and maybe Apple have got it right, I think that we'll start to see more and more that we're sitting in mixed reality. The data explosion. So data is the new oil. Data is growing at a rate that we can't store it as a society, which means that data redundancy starts to become more and more important. And mining and deleting of data will become, again, one of the hot topics, as well as the way we store and the way that we power our data storage. And then plastics recycling and circular economy. I think we share this planet with 7, 8, I can't remember how many billion people there are now, although it is reducing possibly due to those fertility rates. However, we share our globe with a large number of people, and we tend to be pretty wasteful. And so I think for us to continue having this as our prime habitat and not having to try to go with Elon to Mars and populate a new planet, we need to look after this one. And so I think plastics recycling and circular economy will only continue to boom. So changing tact a little bit, what does it take as an investor? Like, what are we really looking for? And I talked about the 99-1. We're looking for doggedly determined founders with the right capability and team harmony. And so I think the best companies are built by founders that can take 99 no's for every yes. And so I think that's something, and that typically comes from having a really strong why. I think that if your why is not strong enough, you shouldn't be doing it. I think we're looking for teams that solve acute and persistent problems with novel solutions. It's a bit of a throwaway statement, but in reality, if you're not solving a problem that is acute, that is mission critical, that people can't live without, and you're not doing it in a way that's differentiated, then it's very hard to get investment. And I think for Australia, we have a relatively small population and economy globally. And so we're always looking for people that are going global as early as they can afford to. I guess other things to consider as a founder of a business, and I talked about why very briefly, and Stuart spends a lot of time thinking about cash flow and his team. But I think there are really 3 runways that determine a founder's success. And Damesh from HubSpot added a 4th, which is culture, but I won't unpack culture. You can listen to him talk about culture. There are 3 runways as a founder that really determine your success. It's how much equity do I have, and how much equity am I willing to trade for capital to grow my business, which affects your cash flow runway. And which I think the why runway is really the one that underpins it all. Because if you have a really strong why for what you're building, you'll get out of day empowered to go and do the thing. If you run out of cash, you'll find ways to keep your business going. If your equity depletes a little bit because you had to raise a little bit too much, if your why runway is strong, you're going to continue building it no matter what. And then when you unpack the why runway, why you, why now, and why this, I think it's really important to have a good look in the mirror around why are you the right founders to solve this problem. When you look at AI making it easier and easier to build new software businesses and launch new software businesses, it's only going to get cheaper to launch new software businesses. The why you becomes really important. An example, we've seen over 30 sales enablement AI software platforms this quarter alone. So why you? Why will you be the one to win in that particular category? Why now? Again, if I was trying to build a solution or sort of navigating AI lead generation a couple of years ago, it would have been a hell of a lift to go and build that solution. But if I was doing it now, it's incredibly easy. And so they both create reasons for why now. And then why is this going to be the thing that excites me to get out of bed every day? and solve this problem. And no matter what, I'm going to solve this problem because it just means too much to me to not solve it. I think which markets becomes incredibly important. And a lot of Aussie founders, when they think about going internationally, think the US is the most logical market to go next. Now, I love the US as a market if I'm selling the right thing, but the US is like 50 plus individual countries to go and sell into. So it may very much be why one particular state within the US, because I sell hospitality software, for example, and the main hospitality buying decision making happens in Dallas in Texas, then maybe that's where you start. It's really carefully identifying where the markets you're going to go and enter are, and why you'll be successful there, why you'll be able to attract talent there, why you'll be able to attract funding there. And then I think importantly, as humans, we live in a world where we have instant gratification at our fingertips. We can distract ourselves with all sorts of things. Building on that why, what's the impact that you want to have? What do you want to be remembered for? And that all helps that why runway. So that was all I was looking to cover today. I'm happy to open up to questions, or Stuart, if there's any questions you had as well.
Sure. All right. Thank you, Matt. That's certainly very insightful there. We've got some questions from the audience, and there's one from Chris. He's asked, can you give a few common paths for a small business looking to buy commercial real estate? What path did you commonly take to fund your startups, past or present?
Yeah, look, I'll talk a little bit about that. So my first startup, as I mentioned, when I launched Donesafe, there were only a couple of VCs in town, and that most of them didn't have any funds to deploy. So the first 100,000 of investments came off high interest credit cards, paying I think 20 or so %. So sometimes you've really, if your why is strong enough, you've just got to back yourself and have a crack. I racked up credit cards while then also quitting my corporate job and taking $40,000 a year with 3 kids at that stage. So not everyone should or could be crazy enough to do that. But I think at the end of the day, if your why is strong enough and it's the problem that you have to solve, and you believe that it's your life's work or your life's work at that present time, sometimes the itch is strong enough to go and back yourself with whatever you can get access to. We were fortunate enough to then go and raise $200,000 from a small venture capital fund. Again, valuations weren't as good as they are today. I raised on a $1.9 million pre-money valuation, raising $200,000. So gave a big chunk of my company away for a very small amount of money. But again, I wouldn't have been able to go and build what I built without that capital, especially after racking up so much credit card debt. And so I think in terms of funding, it comes from wherever you can get it. It comes from yourself until you run out of your own family runway. It comes from de-risking it with friends and family, and the next stage angel investors, and then the next stage early stage VCs. We're fortunate enough to have a number of options of where we can obtain capital. I think if you have an asset-rich business, if you have a business that can have steady cash flow and can be profitable, then debt's also a great option. But you've got to know that if you're paying a high interest on debt, that you've got the growth rate and profitability to sustain that debt. So I've become a fan of debt in the right instances as well. I think, for some business owners, especially when they think about commercial real estate or their first property or premise, if you have enough superannuation to consider self-managed, and again, I'm not going to give advice on this, Stuart can give better advice here, but there are options to look at purchasing, and you don't need a huge deposit. You need a decent deposit, but not a huge deposit in certain instances, to go out and potentially look at utilizing your self-managed super fund to purchase that property as well. So I think that's that, just to answer the property specific question.
Very good. Next question from Tanya. Hello, Tanya. What's the best tip you can give a startup trying to raise funds from VCs?
I think, look, we're fortunate, as I mentioned, to have a number of VCs to talk to, and you need to treat VCs like you would a sales process. Load your CRM with all of the right people, understand the sorts of things that they invest in, understand their interests. Knowledge is power. Information will help you to make the right decision. I'm giving a talk shortly to plug an AWS talk shortly on how to pick your first investor. So by all means, check me out on LinkedIn and see when I'm giving that specific talk. But I think you want to know who's who in the zoo and who's probably going to be right for you. You want to talk to other founders that have taken money from those investors to see if those investors are also right for you. The best introduction to an investor, if you can't get into that investor yourself, is from a founder they've already backed. And so I think a founder introduction is better than another investor introduction. So you can get a founder introduction. Definitely a founder introduction is the way to go forward. But I think another thing that I see, especially a lot of the early stage pre-seed companies doing, if they're able to secure without setting terms, because again, if you set the terms wrong, that may also preclude you from getting investment from VCs, is going out and securing some of that investment from your network, whether that's friends and family or angel investors as well, can all help to show that you're a business worth backing. When you get to the VCs, your pitch deck, there's plenty of advice on how to pitch. I won't go too deep on that, but I think the thing that I would suggest is most teams over-index on problem, over-index on the tactical side of their solution, under-index on why they're the right team to solve the problem. And so teams should be first and foremost, and you really want to go deep on why you are the right team to solve for what you're trying to solve for.
Right. We've got Rodney Joyce. Hey, Rodney. So you give us a situation. So a company has a 4 shareholder split, 88%, 10, 11%. This that much less attractive to potential investors than just having 2 shareholders, 88 and 12%, considering the smaller shareholders would take on that.
I think just to answer this question in a broad way, an investor looks at a cap table and says, are the people that have the domain expertise and the why in the driving seat with enough equity for the long term to build a really big business? Venture capital is all about outsized returns. We're not trying to back businesses that want to go and build a small to medium company. We're trying to back businesses that want to go and own a category. And to own a category, the founder needs a huge amount of why in their tank and needs a good outcome at the end, which can also be traded off against that why. I think for me, if I saw an 88-10-1-1 split, I would be okay if that 88 was that person who had all the domain expertise and all the drive. If that person was the 10 or the 1, I'd be very unlikely to invest.
Yeah, sensible. Second from Rodney. So he's based in Australia, but the market and the customers are in the USA or Europe. If he was seeking VC investment, would he go straight to the USA, or would it be easy to talk to Australian VCs and then USA for later rounds?
Look, I think US investors will back Aussie founders, especially if they're customers in the USA and Europe. But if you're going to be living and operating out of Australia, it may be harder. So if you want to go and try to raise in the US, and it's at the stage that it's an early stage business, pre or early revenue, a US accelerator might be a great approach for you as an Aussie founder, so that you can hit the ground running, build a network, get a little bit of capital through the door, and then be introduced to the right VCs in town. If you have a network over there and you have customers already over there, then absolutely, like you can go and raise in the US. And in my first business, I didn't, but in my subsequent businesses, I've gone straight to the US and raised capital. But that being said, if your plan isn't to relocate to the US and is to operate here in Australia, having some Aussies on your cap table can also be fantastic. I think Aussie investors by nature are often more supportive. From my experience, this isn't me as an investor into my companies, this is me as a founder being backed by both Aussie and US investors. I think that the Aussie investors can sometimes give you a slightly longer rope and be a little bit more supportive if your business isn't operating top quartile of their fund from very early in their investment. And so that can also help you to weather the storm if things get harder.
Yeah, so nice investor community here. We've got Stephen with a question. Given where VC is now, how hard is it for a pre-rev startup to get pre-seed investment? What metrics are they looking for?
Stephen, so I think from my point of view, we're a pre-seed fund. We did 34 investments in our first fund. We've just launched investing from our second fund this quarter. We'll do 8 to 10 pre-revenue investments this year, pre to early, but we're very happy to write pre-revenue. And I think there are a number of funds and angel investors in the ecosystem who are happy to go that early. I think if you don't have a network and you don't feel like you've got the story ironed out yet, an accelerator can be a fantastic place to start. Then there are a number of well-trodden accelerators in the Australian market that can help you get to that point, maybe help you to get some of the proof points you need to go and raise a pre or early revenue round. But I think the thing that I look for in founders, whether they've been through an accelerator or not, if they're at pre-revenue, is that they're just talking to as many of their ideal customer as possible to identify, is this the right place to build, the right time to build, the right thing to build before I start writing code. I'm quite happy to invest in a company pre-product, pre-revenue if the founder's doing that kind of work. And so I think as long as you are doing the work to validate that this is a real problem for a big enough audience, you'll get VC's attention.
I've got John Power here. What are the key differences metrics between a pre-seed and seed round in Australia 2024 from an early stage perspective?
So I think, look, the pre-seed round has not been as impacted as much as seed, Series A, B onwards. I think when an investor looks at a company at the very start of their journey, they know it's going to be a long journey. They know there's going to be additional investors coming along that stack and dilution throughout the entire stack. And so a good investor from a reputable fund is not going to want to see a founder diluted too heavily too early. And so I think pre-seed in many ways has a little bit of a flaw because of that. In today's day and age, launching from Australia in a pre-seed capacity, building software, we'd expect most of the rounds to be $500K to $1 million. And we're not going to want to see founders dilute by more than 25% at kind of the top end, and really ideally 10 to 15% if they can kind of take that sort of 400K or 500K to get started and go to seed. So I think you really want to, the floor price for pre-seed is probably sort of in that $3 to $5 million valuation range. Much lower than that, unless you only need a really small amount of capital to prove because you've got an unfair network, or you've been able to bootstrap it yourself or whatever it might be. You might see the occasional 2 to 3 range valuation, but it's typically 3 to 5 still at pre-seed.
Good. Peter, if you're a sole founder but making solid progress on your solution market fit, will a VC still consider investing, or do you have to have the team in place?
Yeah, look, so I think sole founders, founding a business is an incredibly lonely journey. Do VCs back sole founders? Yes. Can sole founders be successful and build really big companies? Absolutely. Is it as high a likelihood as a team from day one? Probably not. And so I think there's a propensity that a shared load is obviously a more investable strategy, especially when you have founders with a reasonable, not completely equal, but a reasonably equal ownership stake, who are going to contribute with a level of complementary skills, not too much overlap, to use the sort of hacker hipster hustler kind of analogy. Those teams can go further for longer on lower capital typically, and thus become more investable when you sort of risk reward weighting things. Doesn't mean we wouldn't, and we've backed sole founders both as an angel and as a VC fund, where that sole founder has the domain expertise and drive and passion to hire around them. That I think that it just becomes probably a little bit more due diligence on the individual than when you have a team.
Very good. James, so you've given us an equity-based question. So you've got a lead developer who's been a contractor, key player from the beginning, and they're looking to come into an equity role as a CTO. Do you have any advice on how to start this conversation and work out the best split for the key players?
Yeah, look, I think ESOP and equity for employees, somebody who's been there from the beginning, it's very stage specific. I typically send people to, so Founders Institute have a thing called the Fast V2. So I think it's fi.co fast v2 /fast v2 or something. It gives really good guidance for 90% of the cases around an advisor or a early employee joining and their level of activity there. I think, it really ranges though, and it's a preference for you and your team and your board as to how long that person has been there, how long you expect them to be there, what contribution are they going to have to your company, how material is that contribution going to be, how far down the journey are you already, really helps you to identify how much ESOP is fair. I've seen CTOs given as much as 10% of a company and as low as 25 basis points. And so it's, to give you a definitive answer, it'd be quite hard, but like with more information, I could probably give you a band.
Okay, last question here. We've got one from Tass. Any tips to show VCs if you're very early stage, ask pre-seed funding without traction or customers yet? It's a hardware device.
I think, to my point earlier, it's about showing a funnel of intent. So I basically call it the funnel of intent. So on one side of intent, you have a contract that's paying and fully paying. The next level of intent down is a pilot. that is paying. The next level of intent down is a pilot unpaid. The next level of intent down is a MOU or an LOI. The next level of intent down is an email. The next level of intent down is a waitlist sign up, and the next level of intent down is no intent. So I think like it's just about showing that you've spoken to enough of your ideal customer, that you've been able to generate the right level of intent. And the right level of intent is often then determined based on the type of business that you are. So if you're an enterprise software business, having 3 LOIs and 1 confirmed pilot is probably, without any money coming through, might be all the intent you need. If you're a consumer facing product and you're selling widgets and they're $50 each, you might need a wait list of a couple of hundred or 1,000 or more before, without any revenue, before we can see that there's enough intent to buy what you're solving for. So I think it's just about showing the levels of intent and the right volume of intent for the stage you're up to.
Excellent. Cool. Well, I guess that gives us, that's about all the time we have now for the moment, but appreciate a big thanks to Matt for turning here today, and for everybody turning up. I hope you'll all learn something and have something to take away. But yeah, look forward to seeing what you're building in 2024, and see you soon. All right. Thank you, crew.
Yeah, good fun.